Every morning, we wake up. We brush our teeth, take a shower, we prepare for the day. All around the Western Hemisphere, people everywhere follow their morning routines. They wake up, eat breakfast, and go to run. To play. To practice. To serve. To work. Every minute matters. But there's one morning routine unlike any other. New York City. The Big Apple. The economic capital of the world. Center of the American financial system. Home to 19 million people and 2 million companies. Every day, 5 days a week, 52 weeks a year, at exactly 9:30 Eastern Time, the New York Stock Exchange officially opens. When that bell rings, financial institutions around the country and world begin their days. The only difference is that here, every second counts. Stocks, bonds, commodities, futures, options, currency. Since the stock exchange was formed in 1792, investors and traders have come here to buy and sell securities. Every day, as many as 6 billion shares of stock are traded on the exchange. In 2008 alone, over $28 trillion worth of stock was traded. That's over 806 trillion shares of stock. The rules of trading stock are simple, or at least they used to be. When you buy a stock of a public company, you now own a fraction of that public company. For hundreds of years, the process of buying and selling has been done by hand, with orders passing from the buyer, to the broker, to the exchange, to the seller, and back again. However, times have changed.
The New York Stock Exchange was the center of the financial world, the economic engine that helped American business raise capital and create jobs. Today, it's still the public facade of Wall Street and a television backdrop for reporters relaying financial news. But less than 30% of the trading is conducted here now, and the specialists and the noise of the floor is being replaced by the speed and quiet efficiency of computers, and the action is moved elsewhere.
With the digitization of the New York Stock Exchange in 1992, traders gained the ability to buy and sell stocks through computers that process trades in less than seconds. As finance was catapulted into the digital age, so too did a new method of trading evolve. It's called high-frequency trading. Simply put, financial institutions with lots of resources have bought extremely advanced computers and programmed them with mathematical algorithms for trading stock.
To be computer algorithms that look for mispricing, very, very, very short-term mispricings in the market, which is why it's high frequency, because they're quickly buying and quickly selling something, looking to capture those relative mispricings among securities.
By having the fastest computers, high-frequency traders can buy and sell stock in billions of a second, faster than the speed of light, and much, much faster than other traders. The computers process and analyze incoming information about the market, and in this way detect and exploit any major movement on the market. High-frequency trading is extremely complex and incorporates several different methods and strategies.
A more advanced feature of that, which deals with high-frequency trading, is something that monitors the demand of the stock. And not only does it work with price and volume like money flow does, it also works with the size of the trades being executed and basically saying what size are those demands. Basically, are bigger players trying to get in more shares at that lower price? And what size are those trades being executed?
Most of the strategies are based on the fact that certain securities may be moving and there's a time lag to others following. And so if you can come in and quickly buy a thing that hasn't caught up yet, so if stock A moves up and stock B typically moves to stock A but hasn't quite reacted yet, the computer program will realize that, buy stock B, and sell it once you hit the convergence, or short stock A, buy stock B. The idea is to look for those quick repricings where certain things are moving and others haven't caught up yet, or certain things are falling and others haven't caught up yet, which is why theoretically it makes it a more efficient market as well.
Efficiency is a key component in high-speed trading. By harnessing the ability of computers to process and execute trading infinitely more efficiently than actual human beings, high-frequency trading actually benefits the financial market by making the buying and selling of stock cheaper, faster, and more liquid. While these perks are definitely beneficial, some aspects of high-frequency trading can act as double-edged tools.
One of the problems that happens with current market strategies or automated strategies is that they don't adapt to changing market conditions very well, and that if something happens in the real world, like some news story comes out that causes the S&P market index to plummet, that strategy isn't necessarily going to be able to work around that major news story very well.
High-frequency trading can tend to exacerbate trends in the very short term. So if the proportion of volume that's being driven by high-frequency trading is large relative to overall, so it's a big percentage of what's actually the activity that's occurring, you can artificially create psychological change in the market by creating volatility.
Volatility in the financial markets is almost always a bad thing. The more volatile the markets are, the easier it is for stocks and securities to suddenly spike upwards and crash downwards. In 2008, the entire global community experienced a financial crisis which resulted in a worldwide recession that we are still experiencing. While the crisis itself is a result of a housing bubble and other financial disasters created by Wall Street investment banks, the stock crash which accompanied the crisis resulted from unstable market swings in a negative direction as investors and traders sought to cash their stocks and other holdings in while they still could. 2008 would not be the only disaster affected by the volatility created by high-frequency traders.
I understand that when you say that, and yet when you see 600-point moves so quickly, so viciously, that don't seem to connect to fundamentals people are talking about, it feels like something's spinning out of control. Is that just our our lack of comfort with technology? Is it just adjusting to the new reality? Same thing with the flash crash. It seems that something broke or something's not working right.
On May 6, 2010, the Dow Jones Industrial Average fell by almost 1,000 points, in what was one of the largest one-day point losses in the history of the index.
What is going on?
The twist of the story was that the crash occurred in less than 1 hour, and the losses were completely regained by the end of that trading day. After a 5-month investigation into the incident, the SEC concluded that the sudden plunge was caused by a mutual fund selling of $4.1 billion worth of future contracts. The mistake occurred due to a computer algorithm which had malfunctioned. As high-frequency trader computers detected the massive sell order, they rapidly bought and resold stock to the malfunctioning computer trader. This traffic would greatly increase the volatility of the market.
No funny business. You already are.
Much like the 2008 crisis, this induced volatility led to market swings, which in turn led to a stock crash. So, with the risks and benefits of high-frequency trading clearly established, how then should we, as members of the global economic community, look to change and control any dangerous aspects of high-frequency trading? First off, the US government needs to step it up, both on and off the stock market playing field. As the financial world becomes increasingly digital, federal agencies need to upgrade their own computer systems so that they can keep up with the fastest in the field. The SEC is already making moves in this area. In the past year, the SEC has started working with a high-frequency trading firm to upgrade their own outdated computer system in an effort dubbed Project Midas. With the new system, the SEC will be able to monitor the entire market, and in doing so, may be able to see any high-speed trade-related disasters coming. This kind of direct involvement in the market will definitely start to even the playing field, but to really control the trading game, the government will have to make some new rules. First off, trading strategies which break pre-existing rules need to be banned. The SEC also needs to install a system of safety switches in the trading system, so that if an algorithm malfunctions like it did in the flash crash, then trading can quickly be stopped to prevent any serious economic backlash. In dealing with this new technology, some countries have gone so far as to limit trading speed at half of a second, effectively wiping out any advantage sought in high-frequency trading and discouraging its use on a wide scale. High-frequency trading can definitely be incorporated into the modern financial world, but if governments can't keep up with the pace of technology, then it should consider banning complex practices as a last resort. The stakes are high, with over 50% of daily trading volume done by computers and only 2% of financial institutions executing these trades. We can't afford to disregard high-frequency trading and its role in the financial system. High-speed computerized trading is just a taste of what the future of finance will look like. For now, we can only hope to better understand our own technology and capability. Our future potential is limitless. Our only bound is how we must control what we create. The future looks bright.